Hey everybody, Kevin Shortle here once again with another episode for you of the Real Estate Without Renters podcast. Thank you as always for listening to the show. And if you enjoy it, please subscribe and also give me a nice 5-star rating there. I do appreciate that. And it's good motivation to keep bringing you great guests like I have today. Before I get into that, though, just want to talk a little bit about the Noteworthy Convention. As you know, from watching this program, listening to this program, or seeing some of the other social media that I do, you know that I've been talking about going to the Noteworthy Convention, and I didn't quite know how many people were going to show up. I didn't know. I knew who the speakers were. I knew it was a good lineup and everything. And it's been a while since Noteworthy has done an event, so I came in very open and very pleasantly surprised. I mean, it was a great group of people, and that's important. It was a great group of speakers. The content was well laid out, and the after hours networking was very, very good. So overall, it was a good event, and I would strongly encourage all my listeners to attend it the next time that we have one, because I know Ben, who I'm associated with, who owns Noteworthy, was very happy with it as well, and reinvigorated to keep putting that out there. And it's important, for our industry to get together. Talked about a lot of things, and it was good for me to see some old faces, people I've trained 12 some odd years ago, to very new people in the industry. It was a good mix, and it's nice to see the longevity. The fact that, can you make a career out of this business? Can you do it full time? Can it replace your income? Can it replace your job? That sort of thing. And the answer is yes. It takes effort, and you also want to do it the right way. And it's important that you do all things the right way, especially if you're in business. When I did my tip of the day today, that's one of the things that I brought up. If you're a business entity doing business in the note investing arena, let's say, you are held to a higher standard. And if you're not doing things correctly, you're fine until something goes wrong. And then when something goes wrong, everything else starts to fall. And that's what you don't want to do. You're held to a higher standard. So my advice is always do it the right way, do it the legal way, do it the ethical way, and you'll never get into any problems. And that starts from the very beginning. The note business includes creating notes and buying notes that somebody else created. That's really it. So if you're creating notes, you're doing seller financing. If you're buying notes that somebody else created, you're going back and re-examining how somebody created the note. So we're going to start today talking about that creation of a note, because a lot of the inventory that we see as note investors does come through building relationships with real estate investors and real estate investment companies and real estate investment funds that go out, buy real estate, fix it up, and turn around and sell it with financing, sometimes with wraps, sometimes with subject twos, sometimes with cash deals. And we're looking at buying those notes. They're in business with the consumer. We're in business buying those notes. We have to make sure that things are done right. And there's things that you need to do to stay within compliance. Thankfully, we have little compliance to deal with in our industry. We have more than we did in the past. When I first started 30 years ago, it was the Wild West. I mean, it was whatever anybody made up, because there wasn't a whole lot of rules and regulations about it. But that has all changed with the advent of the Dodd-Frank Act. So that's what we're going to be talking about and going into today. And it's an important topic. And I'm happy to say that I've got the new owner of Call The Underwriter. Now, for those of you who've been listening to me for a while, you have heard me talk about Call The Underwriter before, because I've had Russ O'Donnell, the original owner of Call The Underwriter, and then I had Max on as well, who took over for us. And now Dan Deppen is my guest, and he's taking the Call The Underwriter, automating some things, got some challenging, got some really interesting things about how he's going to bring even more value to that service, and I'm excited about it. So I met Dan at Noteworthy, and we had some conversation, and I said, hey, let's save the rest of this for the podcast, and we'll kind of learn as we go through. So I know he's got some great things for us. So everybody, please welcome Dan Deppen. Dan, how you doing?
I'm doing great, Kevin. Thanks for having me on. I appreciate it. Yeah, it's good to talk some more after last week.
Yeah, and like I said, I just believe in the service, and I think it's foolish if you're creating notes to not utilize it, and it's not only staying in compliance but adding value to the notes that people create. But I think some people look at it as, well, isn't that going to delay what I'm doing? If you're a real estate investor, let's say, I mean, time is of the essence, right? You want to get in that property, fix it up as quickly as possible, sell it as quickly as possible, create the paper as quickly as possible. I get it. So some people might look at this and go, well, isn't that just going to slow down the whole thing? What would your answer be to that?
The answer is yeah. I mean, if you're doing a residential owner occupied loan and you actually do it in a compliant way, it will slow you down a little bit. And the reason for that is there are some requirements to send out disclosures on certain timelines, right? So you have to send a loan estimate to the borrower and you have to give them 7 business days to review all of that. And then there's a closing disclosure where they have 3 business days to review. So you can't just like change the terms at the last minute and, shove the paperwork in front of them. So if you figure, you've got that 7 day waiting period, you've got some time, to do the underwriting and then to close. It's probably going to be about 2 weeks, generally, give or take, depending on, how quick the borrower is to get all their information in and, how quick you can turn the crank on the underwrite and get all the disclosures out. But, generally about 2 weeks from when, you kick off the process
Yeah,
to when you close. But I mean, generally, there's also a certain amount of time between when you put a property under contract and when you close.
100%.
Anyways,
Yeah,
yeah.
I agree. And that's, I've done about 150 or so rehabs like that, and
Hmm.
I didn't sell or finance them, but I just sold them out, for cash or people who already had financing lined up. And this was years ago. But there is time in there. So for me, it doesn't look like it's a delay. It's somebody, if you plan on creating notes, put this into your planning mechanism. I mean, I didn't start to market my properties until they were about 90-95% complete, right? Because you didn't want people walking in and seeing, the walls weren't put up yet, or so they'll see
Hmm.
something. Oh my God, what did this look like before? You wait until it's, a little dusty maybe still, and you're in the final stages. But that's weeks before it's going to get to a close anyway. So if you incorporate this into your methodology as a real estate investor and get this process started, it's not going to delay you really at all, number one. And number two, you're coming in with somebody who's better qualified. And what the heck is wrong with that? And if somebody's not willing to go through a qualification process, is that somebody you really want to sell or finance with anyhow? So I just think
Yeah, I mean,
it's a
that's
cog
a
in the
lot of my
wheel that
my
investors need to do. Go ahead.
yeah, like a lot of my takeaways, having really like nerded out on some of the rules over the last year or so, is if you look at what's actually like required by Dodd-Frank and for compliance and ability to repay,
Mhm.
I mean, all of that is stuff that I would want to be doing anyways to de-risk the loan. So I don't really find anything onerous in there. So to your point, if you just kind of build that in as part of your process and you plan ahead, it's really no biggie. Now, if you wait till like the last minute and then you're like, oh, hey, let's do this now, well, then, yeah, that might tack on some time and heartache at the
Yeah, but
end.
you're
But really, it's not that difficult to comply with. I think people make more out of it than what it is.
Yeah, and as you took a deep dive into this, is something you mentioned out at Noteworthy when we chatted. It dawned upon me later on. I said, yes, he took a deep dive into this, but I think the lens you look through though was somebody who's had a fund. I mean, an experienced note investor, a Fusion,
Hmm.
right? Was
Fusion
your
notes, yeah.
Yeah, Fusion Notes. I mean, so it's different from somebody who's just coming from a compliance or a mortgage background looking at that versus someone like yourself who's I mean, if you're putting together a fund and everything else, you got regulations. You have to do it the right way. Why? Because the law, and secondly, because you want to protect yourself. And I think you, with that mindset looking into this, probably looked at it quite differently than someone else. And, what were some of the things like that you discovered?
Yeah, so the first thing when I started diving into it, I just kind of assumed that the ability to repay requirements would have like hard black and white lines.
Yeah.
Like, I was expecting to see, hey, your debt to income needs
Has
to
to be
be
this, and
X
this has to be,
percent and
yeah,
the
yeah.
credit needs to be whatever. And I was fortunate enough to have a conversation with a guy here in Colorado who actually helps mortgage brokers and lenders get set up. And he actually helped create a lot of the state specific mortgage rules here in Colorado. For some reason, they do this thing where there's national rules and then every state like puts their personal spin
Right.
on it. But what he explained to me was that the way it works is it's kind of defined in a nebulous way. Like you got to make sure the borrower can repay the loan. Every lender is expected to create their own standards for what that means, and then stick to those, regularly, and
Mhm.
then adjust them if they start to see a high default rate. And at first, I really had a lot of heartburn with that. I'm like, that's so nebulous. Like, how do you know if you're good? But having gotten into it more, I actually think that makes sense because you're going to have lots of different scenarios, right? So, like different types of properties, like land versus, high-end homes versus other ones, and, differences in region and the country. And then, of course, like market conditions and interest rates are going to fluctuate all over time. So, like the ability to repay is going to kind of be a moving target. Like if they had set a hard bar, then I think they would have landed in a spot where you'd have like a lot of scenarios where they don't make sense, where the hurdle is overly conservative, and then they'd have other scenarios where, the bar is too low. So what we do at Call The Underwriter is kind of use some of the benchmarks from some of the federal programs for
Mhm.
things that we use. And then, lenders ultimately though have discretion on where they want to set the line on, debt to income and credit and other things.
Yeah. And I think the balance point is, the government can't stifle seller financing because then there is a percentage of people who won't be able to buy. So they can't completely shut it down, nor do they want to, but they want to have some regulation in place where investors are not taking advantage of people. So I think the bar they set, because again, I always jokingly say it just you have to show they have the ability to pay. What the heck does that mean? But I think they
Hmm.
have to keep it loose like that because if they make it too strict, you're losing an avenue that some people can buy. And let's face it, seller financing can be used with anybody. I mean, we did a note one time, this is years ago, but I just remembered it. You said something. I mean, the borrowers, husband, wife, one was a judge and the other was a cardiologist. And I can't remember which one is which. It doesn't really matter.
Hmm.
But their credit scores were like 800. And you're like, why would they want seller financing, which typically is at a higher interest rate, when they could easily they just didn't want to deal with it. They're both busy people. And they said, we'll just do this and maybe we'll refinance down the road and move on. But most of the people who use seller financing either number one don't like banks, don't like to work with banks, don't want to go through the minutia, or they simply can't meet the guidelines of what a bank is looking for. So it's either intimidation of the process or avoidance of the process, I think, or, and you can correct me if I'm wrong here, or they simply can't fit the same guidelines as a bank, and seller financing is the avenue that they choose. Is that kind of your experience with
Yeah,
seller
yeah, these days the bank guidelines are tough to hit. So like one of the interesting things to me is, they put the ability to repay rules in place after the financial crisis when, banks were doing all sorts of insane things.
Yeah, liar loans
In
and
the early 2000s, yeah, liar
right.
rules, liar loans, and no income, no jobs, and all the
Yeah,
stuff.
stated
So the
income. Yeah,
government said, okay, you got to have like a minimum bar.
yeah,
And what's interesting is in the time since, banks have become, for various reasons, much more conservative. So where banks, their standards are now like way above the minimum, and then that white space in between is where seller finance plays, and it seems to be a growing gap,
yeah,
in between there. The other thing that happened was when they defined those rules, part of the compliance rules is there's limits on fees you can charge borrowers, right? So it's not like hard money lending. You can't just say, I'm going to have 6 points
yeah,
and, repayment penalties and blah, blah,
yeah,
blah. But there's a limit on the fees you can charge as a percentage of the loan balance. So, generally, if you go over about 3%, you get into illegal territory. Less than 2% is kind of best practice. And so, a lot of times, too, if it's a lower value loan, like if it's a $150,000 sale, banks have certain fixed costs below a certain level. A lot of times they go, it's just not worth their while
yeah.
to mess with because they're limited in what they can charge on loan origination and that kind of thing.
Yeah, that's another great point because I did a whole presentation on that years ago and just saying here's why banks aren't, a lot of the loans that we see are Midwest, Southeast, and
Hmm.
for my audience, which is scattered throughout the United States and even overseas, a typical home, good working class 3 bedroom, two home, 1,200 square feet in somewhere in Ohio or Indiana, that's around $80,000. And it's shocking for a lot of people who are from California and New York and all that to go,
Yeah.
that's it. It's like you couldn't buy a doghouse. I get it, but that's why, we work in these areas. But then if you went to Bank of America's website or Wells Fargo and you look at their loan minimum, it's about 80,000 bucks. They just won't do anything less than that because they lose money.
Hmm.
That's the thing, and that's where a lot of banks opted out of the community rule, where if you wanted to do loans in this area, in this state, you have to set aside a certain amount of money for lower income loans. And they
Hmm.
lose like crazy on those loans. So a lot of those banks ended up saying, nah, you know what? We're not going to do that. So we're not going to lend in those areas. And that's where the non-banks, crept in into that. And so these voids created by the rules and regulations, of which seller financing is a part of, is a very real deal. So especially in these so-called lower price ranges. But again, an $80,000 home in Ohio, everybody, is just a completely different thing. It's a nice home, and but you can't get bank loans on it. They can't make money.
Right.
So great. How are they going to get the loan? Well, through seller financing. And so the seller financing we're talking about, and by the way, I'm talking with Dan Deppen here, and the company is Call The Underwriter. You can go to calltheunderwriter.com for more information. Um, but shoot, lost my train of thought there. But
Yeah.
we're talking here about doing loans from a business to consumer, right? Because
Hmm.
business loans, if you're doing hard money loans and you're a company and you're lending to an investor who's a company, an LLC or what have you, Dodd-Frank rules don't apply, because they look at business people of saying you should be an expert in your field. You don't need our help. But the government does look at this as if you're a consumer, you don't know enough about anything and you need our help, essentially, is what we could break that down to. So this is what we're talking about, is these loans that we're doing as a business to a consumer right away. So I wanted to point that out to everybody. And again, I just think it's a smart thing to do. So how are you automating the process? We started talking about, is this, kind of a drag on time for an investor? And the answer is no. You put it in your system and you won't even notice it. It's done in time. But you're working
Hmm.
on some things, I think, to expedite the process as well. Is that correct?
Yeah, I'm trying to make it easier, and it's a work in progress. It's a work in process. It's like a giant elephant. I'm just taking like little bites at it
Hmm.
every day. But traditionally, way these processes have worked for RMLOs, it tends to be one person, going back and forth in their email box with like a bunch of files,
Hmm.
and maybe a spreadsheet, and then their loan software to try to keep track. So I've been building a lot of stuff on Zoho CRM. So part of that is just having like standard FAQs and responses to people, and doing things to kind of educate people ahead of time on the common questions so they know what to do. And it's just setting up some pretty simple like workflow automation. So, someone submits a deal to us, they get an email back with instructions. Hey, here's what you need to do next. They'll get like the initial invoice back right away. And it's things like that to try to streamline the
Yeah.
process. And then, now there's two of us underwriting files, or hopefully should be three here in the next month or so, and then just setting up some backend systems so that multiple people can work on the same file if needed, and you can keep it straight and keep things moving. One of the things I'm trying to do is try to make it so that having a file move forward is not dependent on one individual who may get sick or have something going
Right.
on. I want to have this thing where we can kind of always have somebody on call to kind of keep things moving along in the process. And one of the things I like about underwriting, and actually is one of the things that attracted me to buying loans, because I think it works the same way, right? Like even though every loan in some ways is kind of its own special butterfly, they really lend themselves to kind of rinse and repeat processes, right? And I did a similar thing for buying loans. I'm sure you've done it like way beyond what I have, where, you kind of know the property value, the loan balance, the loan terms, different characteristics, then you can kind of put that into a model and figure out what you need to do. So they're all different, but you can kind of build a system and then, do them rinse and repeat.
Yeah, I think what you're probably running into is it's a two-way street. you could completely automate, I think, this program. But the problem is sometimes the consumers are like, that's all well and great, but I don't have a computer, or I'm not as savvy on a computer as I can. So as much as you could automate something, you still have to keep it very tactile with some people, simply because they may not have, the computer skills necessary to jump on and follow through, because I could envision like a little system of here's where you are in your account and all that, log in with your password.
Mm-hmm.
And then you run into, well, not every consumer is going to be as adapt to that as needed be, and sometimes a language barrier, may come into play there as well. But I think the other part of that solution would be, hey, investors who are listening to this program, understand that this is a part of your new process, right? Or it should be, right? So get it where it's in your overall checklist, get this thing started, but set your borrowers up immediately on here's what you can expect. And I think if investors are proactive on, and maybe you have handouts or something, maybe you don't, you can let us know in just a minute, but maybe
Mm-hmm.
you have a package that an investor can say, look, get started on this, start to fill this out. We'll have, Call the Underwriter, contact you and follow up. But this is important. Get this done. Start looking up your taxes, or start looking up, get your W twos or fours or whichever one it is.
Yeah.
Get your paperwork all starting to set up, and it'll make this process quicker. Because I think that's what it's going to take sometimes, is that investor pushing that consumer to do it. And then I'm sure there's going to be some times where consumers are like, oh, sure, I can log in, I can do all this, I can upload the documents and make it all easier. But yeah, I think you're going to probably always be constantly
Yeah,
with
it's a
dollars.
mix. I mean, actually, the majority are okay because right now I've turned, a lot of the forms that the borrower has to fill out into online forms that we can move right into our CRM. And so it's eliminated a lot of this like manual. In the beginning, I was getting, emails from people with like 9 cell phone photos of,
Yeah.
a
And
loan
then you got to take
application,
that, and then you
and
have
you're
to put it on the,
manually
yeah.
transcribing. Now, some still do need, help, and that will kind of always be the case. That percentage is probably a little smaller than I would have guessed, actually. And then, the number one request I was getting was a request for native Spanish speaker to get on the phone with some of their borrowers. And I've got that now
Hmm.
part time. So now there's a checkbox on the intake form. Like if you think you need that, I can have Carlos reach out to the borrower and he'll help them
Right.
through the process. So yeah,
Yeah.
it'll never be 100%, but better
Yeah.
than 0%.
Well, no, even taking the forms and making them, where you don't have to take information and reload them and all that. That's automated, and I think that's a great step forward on this. Now, you're based out of Colorado. The company's based out of Colorado. But you can do business nationwide, or are there some states that prevent
Yeah,
that?
so we can do nationwide. So the way they define the rules, so the way we do it, we're an underwriting service that helps the lender. The lender is actually originating the loan, and you can originate up to 3 loans in a year without an RMLO license. That's how most of our clients do it. Although just recently acquired the company an individual license, RMLO license for Texas. So if you're in Texas, we can do as many as you want. And I should have the Arizona license here shortly. So once we get that up to speed, we'll be looking at additional states, mostly around like the Southeast. It's kind of like Texas, Arizona, Florida, Georgia, Carolinas are some of the hot spots for seller finance.
Right, right. So, great, no problem there. And I guess that on a breakdown as to qualification, there's essentially 8 required elements that you look at. What are those elements that you look at with the ability to repay?
Yeah, I can't list all 8 on the fly, but I'll give you the overall, process. So one of the first things we need to do is understand is like, where does the borrower's income come from? Do they have a W-2 job? Are they self-employed? A lot of borrowers are on Social Security or VA benefits.
Hmm.
And then, you want to understand the stability of that, like how long have they been doing it? And then you want to get that income documented. So if they're a W-2 employee, it's generally like a W-2 and a couple of recent pay stubs to verify what they're earning. If they're self-employed, those are a little trickier. We generally want to get 12 months of bank statements. And those are a little more work because you got to comb through there. Sometimes people like commingle business stuff and personal stuff. And then it's also good if we can get a previous year's tax return from them. Although, that gets tricky because depending on the type of business, a lot of times, tax return kind of understates the actual income depending what they're doing, especially if it's something where like they can claim depreciation and things like that. Or, if they're doing Social Security, VA benefits, then we want to see their award letter. And then we'll do a soft credit pull on them and look at their other monthly obligations. And so we'll look at the terms of the loan, like what's the PITI, what are the other monthly payments they have, whether that be an auto loan, credit cards, things like that. So we kind of look at their total monthly debt bill, and then we look at their total monthly income and we figure out their debt to income ratio. Now, this is where, lenders vary widely in what they'll accept. We use 57% as the benchmark, which comes from FHA.
Yeah.
I believe, other lenders like to go lower,
Hmm.
down in the 40s. You theoretically can go higher than that, although like me personally, I would not feel comfortable at a 57% debt to income ratio. Like if I was buying a house and it was putting me at 57%, I'd figure out something else. Like I wouldn't want to,
Yeah.
I wouldn't
By the
want
way,
to go
everybody,
there.
just in case you're newer to the business, 57% debt to income ratio means 57% of their money every month is going towards paying for the house, so that's what,
Yeah.
when that
Yeah.
starts
And
to
other
get that
debts.
high,
Yeah.
you're kind of like,
It's,
something
it's,
goes wrong, they miss a week of work or whatever. It's, yeah.
yeah, it's a lot. And then we look at their credit. So we look at their credit score. Like 620 is our benchmark, but that's kind of
Right.
another one where different lenders have different standards.
Yeah.
If they're below that, we kind of mitigate that. If
Yeah. I
they
think
can
FHA
provide
is
a,
going as low as 580 too. So it's crazy. Yeah.
yeah, yeah. And I've seen some scary credit reports. I pulled one the other day, it was like 480. Like I've seen one that's like
Yeah.
in the mid 400s, like which I didn't even know that was
Yeah.
possible. But in that event, like it's not necessarily disqualifying. But then we like to get a verification of rent letter from a landlord just saying, hey, this person paid their rent for the last 12 months. So if we can ascertain that, okay, they've made their housing payment on time for the last 12 months, and oftentimes their rent payment was higher than
Hmm.
their new mortgage payment,
Right.
then that can be okay. Some of the red flags, that can be problems would be like recent bankruptcies, foreclosures, things like that. Or if they got 60 days behind, on their mortgage in the last year or two, that's a rough one. If they weren't paying on time on the regular mortgage, then, then that one can be a challenge
Yeah, because for us,
as well.
Dodd-Frank doesn't really say anything about credit. It's really more the ability to pay. I mean, credit's an
Well,
insight,
it's
but
weird. So they actually include credit in one of their 8 elements of ability to pay. To me, though, that's not really an ability to pay. That's more like a willingness to
yeah, it's a
pay.
historic. Sure, I mean,
A
somebody
lot
could
of
be
times,
in on
yeah.
their credit, lost a job, and had whatever bankruptcy, and now they're working their way back, and they can afford it. Yeah.
Yeah, yeah. So, I mean, those are kind of the main things
Okay, so
that we
where's the
do.
income coming from? How much is the income? What's the credit look? These are amongst the 8 things that you're looking at. Now, speaking of credit, um, Social Security numbers. What else can you take for credit?
Yeah, so we can also take ITIN numbers. I mean, basically the requirement is we have to be able to pull credit. And so you can do that with a social security number or an ITIN number. You got to at
What's an
least have
ITIN
one.
number for everybody?
Oh gosh, I forget what it stands for, but it's basically the one where they're paying taxes, but they weren't necessarily born in the US is the
Right.
way I think of it. Yeah.
Yeah. Yeah. So yeah. Now, if they don't, if they don't have a green card or something like that, then they're not going to be certified. Doesn't mean, right?
Yeah, because sometimes it's a misconception. Sometimes people think they can't qualify a borrower because they have an ITIN, but you absolutely can.
Yeah.
Now, I've seen some where they've had a green card and like a green card number, but no ITIN,
Yeah.
and that we can't use because we can't pull credit
Right.
off a green card number.
Right. Yeah. Gotcha. Gotcha. So yeah, the I-10, you're here, you're paying taxes, but not quite a citizen yet. Now I've seen
Yeah,
quite a bit, and as you said, Texas is a big state for seller financing, and I've definitely seen that on other stuff, and notes have been great with
yeah,
that.
and there's a lot of lenders that almost like specialize in that kind of borrower because I mean they tend to be very sound borrowers for the most part. Yeah.
Mhm. And of course, now there's a cost to this service, and if I'm the investor that hires you, I'm your client, so I'm going to have to pay you, not the borrower. But a lot of times we can pass that expense on to the borrower, right? Explain how that works.
Yeah, the short story is it's free for you. But so kind of the way it works is, right, because this is seller finance, right? So it's a little different than the traditional mortgage world.
Hmm.
The traditional mortgage world, the consumer goes to a mortgage broker and they say, find me a loan, and they go shop for loans. This is kind of the opposite, right? Like you're starting with the lender, they've got a house they're selling and they have loan terms, and then they're finding the consumer.
Hmm.
So we work on behalf of lenders. And so because we work on behalf of lenders, we can't collect money from consumers, right? Because if you think about it, let's say a consumer came to us, they paid us money, and then the lender said, I'm not giving you the loan. Then, consumer's going to complain, like, what kind of scam is this, right? Like,
You're
that's
right.
not going to
Right.
be good. So the lender has to pay Call The Underwriter. But then what the lenders always do is they include it as one of their closing costs when they close, and then they get reimbursed by the lender. Now, the way that we invoice it to get the
They get
incentives,
reimbursed by the borrower.
or reimbursed by the borrower. Yeah, yeah. I'm sorry.
Yeah. That's
Yeah.
fine.
So the way we do it to keep the incentives right is we invoice it in two steps. So so the fee right now is $7.99, but the lender gets invoiced $149 when they start. And because sometimes we get into these files and you find out the borrower's just not going to work out, right? And
Yeah.
so we do it that way so that if the lender does have a bad borrower, they're not out the 799, they're not out the 149. One of the things I really always highly encourage people to do for a variety of reasons is to pre-screen their borrowers. Because if you have a short conversation with the borrower up front,
Mm.
you're going to identify 90+% of problems up front. So that also provides a little bit of an incentive for the lender to do that pre-screen process. Then once we get through the underwrite, everything's looking good. We're ready to send out the loan estimate. Then we invoice the lender for the remaining 650, and then they get reimbursed by the borrower when they close.
Gotcha. So what could an investor then with the pre-screening, um, what does that look like? And I know on your website, which again is calltheunderwriter.com, everybody, you can go to that website, and if you scroll down to the bottom, you'll see that there is a pre-screening worksheet that you put together. But if you could just kind of outline what a pre-screening
Sure. Yeah,
might look
I'll
like.
explain what it looks like, but actually first I'll explain why it's so important because it's one of those things that's sneaky. It's not always obvious up front. The scenario you're avoiding that I've seen a bunch of lenders get into is they don't pre-screen the borrower, right? They go under contract. And like we were talking about earlier, maybe this whole process takes a couple weeks to go through. So they're into this for a couple weeks. They get to the end and then they find out, oh, wait, this borrower is not very good. Like this loan just might flat out not be compliant, or this is a pretty sketch borrower.
Yeah.
And then they have this kind of ugly choice. Like, do they roll with the bad borrower or do they start over in the process? Because like I said, time is money. People are hesitant to start over. And so when they don't pre-screen and you find out the borrower's bad later, people get really painted into a corner.
Yeah.
So that's why it's real critical that you do that. The pre-screen process is pretty easy. And there's like a one-page guide on the website, but you're just having a short conversation with the borrower and you're just asking them those questions about, okay, how much income do you make? How much, how much are you making every month? Can you document it? There's a lot of people that do like under the table stuff
Sure.
and they have plenty of the money, but it's not documented and that, you can't do anything with,
Yeah.
unfortunately. And then, you want to ask them about red flags, bankruptcies, foreclosures, have you been late on mortgage or rent payments, that kind of thing. And like,
Yeah.
95% of the issues you're going to be able to suss out like right then and there. It's pretty
Yeah,
simple.
that's smart. And I think on your site with there's the doc on there. It's maybe 8 questions, everybody. I mean, it's not difficult. And if you're doing this right and you have several people that are interested in the property, I could even see you handing this form out and just say, give us the answers to these following questions, and that kind of weeds through some people right there. It could be a big time saver. And you had a spreadsheet on there too. And
Yeah, that's for kind of, if you want to do some like back of the napkin debt to income to figure out if they have enough income, then you can download that and use that. It's nothing fancy
Yeah.
that's
Very
on there,
simple.
but that was something that people asked me for, and so I threw that up
Yeah.
a
No, it's
while
smart. I mean,
back.
it's the same thing when I'm looking at notes, my methodology is to keep it simple and not waste time. And, I look at three formulas, like I'm performing notes, the three ratios. And if those
Hmm.
ratios don't meet, I'm moving on. It's very simple. So debt to income, because the ratio, because it's so important to this, that seems like a logical, simple screening thing to take a look at. Now, you may not even need a spreadsheet. If you just learn the numbers, you can just do the quick math on it and just say, oh, okay, you make this, and here's what the your payment would be on the loan, and run the numbers. And if they can't meet it, you're not wasting your time with that particular borrower. And this does one of the things. So I'll switch gears here. As a note investor, we look at a lot of these notes that people are creating. And I absolutely give more credence. Believe me, when I'm going through a due diligence folder and I see Call the Underwriter documents, because I've seen them so many times, I'm
Hmm.
like, ah,
Yeah.
this one's been done by Call the Underwriter. I'm in good shape here. I don't have to go through all of those files. You've done that, and I look
Hmm.
like, did this person, approve that? That goes a long way with not only me but everybody I teach in the business. There is a difference between someone who's gone through that process and someone who doesn't. I mean, because part of our job in buying these notes is forecasting what's most likely or least likely to happen in the future. And if I see somebody who's gone through this process, I understand without having to go through the documents. So you save me time, by the way. I
Yeah.
just see that, and I'm like, good, moving on. Then I just look at quick payment history and go, yeah, they're going to continue to pay. They've been pre-screened. They're in good shape. So as long as we don't have, the unforeseen stuff, loss of a job, income, divorce, that sort of thing, and they're
Yeah.
going to continue to pay, and everything's going to be great. So when I'm looking at negotiating prices for notes, if let me put it this way, if I had two notes and everything was identical except one was Dodd-Frank certified and one was not. Everything else was the same. The price of, whatever. Guess which one I'm going to buy?
Yeah.
The one that's been screened. Um, we didn't talk about penalties, and I don't want to leave on a negative, but I don't think it's a negative.
Hmm.
If you understand what the penalties can be on some of these deals, if you don't do it the right way, they can be pretty severe. And now I've never heard of anybody going to court over it. I haven't heard of any court cases where this has been enforced. So I'm not trying to scare everybody, but it's something that we should be aware of, that if you do a loan with a consumer, and I think it's still 3 years, and you correct me if I'm wrong, if they up to 3 years end up defaulting and they lawyer up and say, they never certified me, I never qualified, and I think they set me up for failure, there's going to be repercussions on that, which could
Yeah, I mean,
include
there's really no
having to pay
limits.
all that
They
money.
could do that whenever, and I've done a lot of looking at, the court cases where the CFPB and state attorney general have gone after people. When
Uh-huh.
they go after people specifically for not originating loans, right, it tends to be
The big guy.
larger players doing like objectively terrible stuff at
Sure.
scale. So if you create a one-off note, like you're not going to have like a SWAT team, on your yard, even if you did it all wrong. But I think the scenario to your point, the one that will get you is the one where borrower defaults typically early on. You start foreclosing, and then they fight it and say, "Hey, this guy was a predatory lender. I never had the ability to repay." In which case, the judge will ask you, like, "Okay, did you send out all the disclosures per TRID? Did you validate the borrower's ability to repay?" If you got this whole underwriting package, say, "No, we did all the stuff. Here's all the
Yeah.
data." Like, you're good. Like, it's very, very simple. So,
Yeah.
that's where it protects you from, the downside of having a non-compliant loan. But I think, the other scenario that's way more common is if you're going to resell the loan, because the potential buyer of the loan is going to want to see that. And a lot of people just won't make an offer, if you don't have it. So it's going to be easier to sell, and it's going to sell for quite a bit more if you have that. That's really the main benefit
Yeah,
from it.
I agree with you. The legal penalties, they're definitely going after the big players. I mean, the old Harbor case and all that was based upon that.
Yeah.
Harbor would, and this is all public record, so I'm not talking out of school. Everybody, you can Google search it. It's pretty widely known out there. They were just taking these houses. They weren't quite fixing them up at all, sometimes not at all. And first person come along with 500 bucks, 750 bucks, they do seller financing for them, and so they were doing this on a large scale. And yeah, that becomes a target because you're doing that. If you're a consumer and you're doing this and on a smaller scale, there's no Dodd-Frank police that are looking for what you're doing. So I don't want to scare in that fashion. But after hearing all of this, your takeaway should be, if I'm creating loans, why not have a qualified person? Because number one, it's just smart. Number two, you're staying compliant, so you don't have to worry about those issues down the road. It's adding value to your note. Those three reasons alone are reasons enough in my mind to do it, the right way. As a note investor, we can buy notes that have this or not have this, but I certainly give more credence. And believe me, it is something when I see that in a folder, I'm like, oh, yes.
And you don't have to pay for it. The borrower
Exactly.
pays for it. So
Exactly.
it's kind of
Or
it's
you could
kind of
split. I
nutso
mean, the
not to
other
do it.
thing,
Yeah.
it's 799 bucks. All right, well, split it with them then, because again, ultimately you're collecting back the investor. I'm sorry, the investor is collecting back from the borrower. So if you want to split it to him as being a nice guy or pass the whole cost along, that's up to you and your business model. But I think the benefits are just, far exceed 800 bucks and whatever it costs and having a good, I mean, let's face it, if you were a landlord, I would hope that you
Mhm.
that you do a screening process for your tenants, just kind of makes
Yeah,
sense to
and,
do
and I
that,
mean some of these
you hear
loans are
landlords with horror stories, you go, yeah, I really should have screened them better. It's like, you think, you
yeah,
think,
because it can be a nightmare, right? Because even though you have the
yeah,
ability to foreclose, I've bought a lot of non-performing notes over the years, and I've
yeah,
had like easy foreclosures and hard ones. Even if you're in like a non-judicial state, it doesn't always go the way you think it is. Borrowers will file bankruptcy to drag it out. I mean, it was a one-off, but I remember, COVID closed down the court. There's all kinds of stuff. Like sometimes people like sell it as, oh, you just foreclose, you get it back. Sometimes, but not always. That
hey,
that that option
sympathetic
can be
judges too,
nasty.
like you said, with COVID and all of that. What judge wants to put a person out of their house? I mean, we don't want to put people out of their house, but they can't stay for free, forever. And so yeah, that definitely happens. So we should be doing everything we can to put in the best possible person that can afford it. They're happy, we're happy, everybody moves
Yeah,
on.
and I'll call out another quick couple of things like not to do that I see people doing sometimes is they go, you mentioned earlier, right? If it's an investor loan, if it's an LLC buying it, Dodd-Frank doesn't apply. But Dodd-Frank applies when it's owner occupied. So sometimes people go, oh, well, just make an LL, tell the borrower, just make an LLC, and the
Uh,
LLC bought it, and you'll live there. Like you're deep into fraud. Like you can get that you can get into like really serious
yeah.
trouble for if you're doing that. The other thing you see people doing is, and some people teach this is, oh, when you create the loan, have the borrower sign a deed in lieu. So if they default, you don't foreclose, you just record the deed in lieu. And that's number one, it's sketchy as hell. But number two, the deed in lieu is effective from the date they signed it. So if you collect payments for 3 years and then try to enforce the deed in lieu, well, then technically you need to give the borrower all that money back you took from them
Oh,
because the
that's
thing is
interesting.
off. And so you can that can get nasty as well. Although I was talking to somebody who owns a
So
nationwide
it's not the
closing
date of
company.
recording. I got to look into that. It's not the date of recording of the quick claim if you file it. It's the
Yeah, I
date.
had someone look into that for me that I try.
Yeah.
Yeah, I'm pretty sure that's correct. Yeah. And somebody that runs a nationwide closing company was telling me yesterday that like a lot of states are just disregarding those. Like if somebody signed a deed in lieu at the time that they closed, they just go, sorry, like tear that up. Like we're not
Yeah, especially if the
dealing with
person's
that.
created equity in the property, made a lot of payments. It goes beyond. Yeah, they'll make you foreclose anyway on stuff
Yeah,
like.
because it's kind of predatory. Yeah, it's not
Yeah,
good. Yeah.
it can be because it's definitely been a safe way to do it. And I've even had an attorney okay it in the past.
Hmm.
It's not common practice, but it is something that, well, it's kind of like a contract for deed. A lot of people will do these things on contract for deeds where the lender is on the title to the property. They have the legal title,
Hmm.
not the equitable title. And I tell everybody, look, still understand that you might have to foreclose. Everybody thinks, oh, it's just an eviction. It's like, it could be. If the state has a state specific law that says that, it should be that way. But a judge could overrule that, or it's in a state that doesn't recognize those kind of arrangements, or the judge
Hmm.
has enough credence, or the judge can go either way. And I think most judges today in states that are in question about contract for deed law, they're going to side on the favor of the consumer because, again, give the consumer at least a chance during a foreclosure process to somehow come up with the money corrected, or have you guys work out some kind of arrangement on there. So yeah,
Yeah, a lot of states are really down on contract for deeds because some people have used them for bad behavior.
yeah,
Maybe Harbor was one. I think I see a lot of people creating them now as part of subject to deals. They want to do a land contract
yeah.
and not record it to try to avoid triggering due on
Tax
sale.
payment, yeah.
Yeah, that's yeah.
Yeah, like I said, there is some leeway in this business, but it goes back to what I first started with. If you do stuff, legally, morally and ethically in this business, and that includes the compliance issues, you're never going to run into problems. It's when you start to skirt too many corners, and I've seen people get into mistakes when they buy a note. That, of course, that's when it's made. I see people
Hmm.
do this all the time. They go, "Well, I did it like this," and I said, it's fine as long as everybody's paying. It's when they don't pay and you go to foreclose that they go whoop way back here, and now you're in
Yeah,
trouble.
and,
It's
and the
like
thing
you could have
is,
prevented it. Yeah,
it's a numbers game, right? So like if you're doing like a one-off, you're probably not going to see a lot of these problems. If you do a
yeah,
hundred of them,
yeah,
you're going to see like all kinds of weird
yeah.
one-off things. It's like back when I worked in aerospace, I remember a friend of mine they were doing this contract with Boeing. We were like a smaller player and they didn't like part of this one design. The guy's like, well, we've flown 6 of these in space. We've never had an issue. And the Boeing guy was like, well, we've flown like 350 and we have. So we don't, so if you do
Our
enough
sample
of
size a
them,
little, yeah.
yeah, if you do, and hopefully like you're scaling this stuff up. So if you do enough of these, those little corner cases eventually get you. Yeah.
Yeah, 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 100% agreed. So, man, time flew. I could go on and with it. It's a great topic, interesting topic, and we'll have to have you back on and talk just about regular notes and such as
Yeah,
well
for sure. Anytime. Yeah.
another time. And so thanks everybody again for listening. If you're looking for me, just go ahead and shoot me an email, Kevin at kevinshortle.com. And remember that's spelled Shortle. So it's Kevin at kevinshortle.com. I can send you a link for a 30-minute phone call, no charge, just to talk about the business if you're interested, see if I'm a good fit for you, because I've trained more people in this industry probably than anyone, and work directly with people one-on-one. And it's uh, it's a great program where it's a true mentorship. So if you're interested in that and follow up, let me know. If you're have some guests you'd like me to have on the show, please let me know that as well. And any other comments that you have, please send my way. But Dan, thank you once again for being on. And remember, it's calltheunderwriter.com is the website. And again, appreciate you being on. It was great to see you at
No,
the
thanks for having me on. Appreciate it.
probably
Yeah, I'll do it
are you
again
going to
soon.
Nashville?
I will be in Nashville for
All right, so
DME
I think I've
in
committed to
May.
Nathan to do to do
Yeah.
that. I think I'll be out there for that conference as well. So good to see you, my friend.
All right. Good to see you too.
Thanks, everybody.